So thank you again, Raluca and Jose, for inviting me to present this paper here. I think this is really the perfect forum to share our work and get feedback. So this paper is called Credit in Business Under Usury Limits. A discerning eye might note that the title is different from when the initial invite was sent out, which highlights that this is very much work in progress. So we are super excited to get all of your feedback. This is joint work with several current and former colleagues at the New York Fed. And I would also be remiss if I did not mention that we've had the help of some really awesome research assistants, in particular, Sue Pham and Gabriel Leonard, who are both here today. So thank you both. Today, presenting Credit in Business Under Usury Limits, and I will just jump right in. So usury limits, which are caps on interest rates for loans, have existed pretty much as long as written law has existed. So here I have a quote from Deuteronomy from the Old Testament. So basically one of the oldest sources of written law that there is. You shall not lend upon interest to your brother, interest on money, interest on victuals, interest on anything that is lent for interest. So you really shouldn't be lending at interest at all, according to the Old Testament. And this sort of sentiment has persisted through this day in the United States. So here I have a map of limits on APRs for 2-year $2,000 installment loans across the US from the National Consumer Law Center. So the way you could think about these are essentially limits on relatively medium to long-term loans at pretty high amount. And you can see here that for most of the country, there is some sort of rate cap that exists for these types of loans. So for 34 states and DC, loans are capped at 36% or less. 36% is kind of an important number for reasons that I'm going to discuss later. And then 9 states cap these loans between 36% and 60% APR. And the rationale behind these laws is essentially that they are good for consumer welfare because they protect consumers, but there isn't really that good of an understanding of how good a job they do protecting consumers. And at the same time, we know as economists that oftentimes you pass a law and there's unintended consequences that can have broader economic effects. So there's also not a great understanding of what the real economic effects of these laws are. So in this paper, we are going to ask the question of how do these usury limits, or again, caps on interest rates for consumer loans, affect credit and business conditions? And we're going to use 2 sources to do this. One is going to be individual level household credit bureau data, which of course, many of you know is housed at the very Philly Fed that's hosting the seminar. And 2, county level business establishment and employment data to study usury limit changes in 5 states from 2016 to 2021. We're going to be doing 2 things here. So first, we're going to be looking at access to credit and credit health and how that varies according to differences in borrower creditworthiness. And then we're going to look at whether there was a change in, whether any change in credit conditions corresponds with a change in local business conditions. And what are we going to find? So first, and this, I should be clear, is consistent with the previous literature. This is something that corroborates existing evidence rather than introducing new evidence. We find that less credit is extended to the riskiest borrowers after usury limits. Something that's a bit more surprising, though, is we actually find that lenders are extending more credit marginally lower risk borrowers after these laws pass. So this suggests that there's a sort of reallocation occurring between high risk borrowers and low risk borrowers. Perhaps most interestingly, though, what's really new about this paper is we're going to find that businesses are actually affected by these usury limits. We see a decrease in business establishments after these usury limits. And in particular, we see this for counties that are really reliant on small firms. So counties that have high small business intensity and high self-employment intensity. So counties where a lot of the economy comes from businesses that may not have access to other types of credit. So this indicates that because people may use these sorts of loans to invest in their own small businesses, usury limits can actually affect business activity. So I'm not going to spend that much time on the literature, just given this is a short seminar, but I want to talk briefly about how this relates to the literature. So if we think about the literature on credit constraints from usury limits, this is a very old, expansive literature. This list isn't exhaustive. There's a lot of work in this area. And it's pretty well known, and I would say intuitive, that after usury limits, high-risk borrowers are often shut out of credit markets because it's no longer legal to lend at their equilibrium interest rate. We're going to find evidence supporting that. What's really going to be new here is our evidence related to the businesses. There's also literature on possible benefits of usury limits. And essentially, the argument here is that usury limits benefit borrowers because they may be essentially tricked into borrowing at high interest rates due to their behavioral biases. We're going to find, though, that even though you have this decrease in credit, there's not any corresponding change in delinquency. So this kind of calls into question this type of benefit from usury limits. So that's how we contribute to that literature. So now, before I get into the analysis, I'm going to go into some detail about the setting. By the way, at this point, if there's any questions, feel free to jump in. Happy to hear all your thoughts. So, as I said before, these usury caps ban provision of high-cost credit, and really the rationale behind these is there's a sense that borrowers have behavioral biases, which lead them to take out to borrow loans that aren't in their interest to borrow. And at this point, there is actually a national usury limit in the US, specifically for members of the military, called the Military Lending Act. It was passed in 2007. And what this did is it capped loan interest rates at 36% or less for members of the military. And many states since then have enacted caps at 36% or lower. So what we're going to do in this paper, the key of our analysis, and I'm going to go into more detail about this later, is we're going to look at states that pass usury limits between 2016 and 2021. In this map, these are the states that are circled in red. And of course, I think the first thing you would think to do is to compare them to all other states. But the problem there is that most states have a usury limit already. So that doesn't really make them an ideal control group. So what we're going to do is we're going to compare them to the states that had no usury limit at any point in the sample, which are circled in yellow in this map. Here, to give you a sense.
Just a clarification, do usury limits apply to payday loans as well? Or there are some states that have some exemptions for payday loans?
So usury limits would generally apply to payday loans. That's less the variation that we have in mind here, because specifically we're looking at the limits on these 2-year $2,000 installment loans. So the same rationale does kind of apply to payday loans, but we're especially interested in a more like long-term, higher volume source of credit.
Thank you. I think Bob Hunt has a question.
Mm-hmm. Hi, Lee. If I'm following this, the usually you have in mind is typically applies to personal loans, probably installment loans. And two questions follow from that. One is, do the state laws actually distinguish between a loan of that sort to a business or not? So often usury ceilings are waived for businesses, or is it this is really an issue of I will go and get the loan in whatever way I can, and very often I'm actually pledging my own resources as opposed to the resources of my business?
So, apologies, quick question. I'm getting some notifications popping up. I don't know if y'all are seeing them. But okay, great. So
I'm actually seeing them, just to let you know.
okay. Hold on. Let me just turn off all of the notifications. Okay, great. I think that should be it. So just to recap, you were asking if these laws distinguish between personal loans and loans for business. So I think these generally are personal consumer loans. The sorts of variation that we're interested in here is especially in terms of very small businesses. If in practice, a loan for business could be a gray area with a personal loan. So the exact sort of variation that we have in mind, and we have a test where we can capture this very well because we use self-employment, would be like you're an Uber driver and your car breaks down and you go and get a loan to fix the car. There are corporate usury limits out there, and there's some work that's explored that, but we're not going to be using that sort of variation in this paper. So just so that you could see the exact laws that we're using, I have the 5 usury laws in this that we use in our experimental design. So we're going to be looking at laws passed in 5 different states. What's nice about these 5 states is they capture a pretty wide range of states across the United States. So we have states that are more urban, like Ohio and Illinois, where there are some fairly big cities and large populations. But we also have more rural states as well. We also have a pretty wide range of limits in the sample. So most of them are in this 36% range from the Military Lending Act. One is lower at 28% in Ohio, and then one is super high. New Mexico's is 175%. You may be asking yourself, does anyone really borrow at 175%? Does this law really bind? We did look at the individual states, and I can tell you it does. We seem to see effects in New Mexico, and there are sometimes loans that will be at higher rates than 175% even. So we capture a pretty wide range. Something that you may also notice just looking at the dates, I think the elephant in the room is that some of these laws were passed in 2021 in the middle of the pandemic and the recovery from the pandemic. So we are going to do a robustness check where we just exclude the pandemic years as well. So just to go through the data that we use, our information on usury limits is going to be coming from the National Consumer Law Center, the NCLC. Our credit analysis is going to be coming from the New York Fed Equifax Consumer Credit Panel. I could spend a lot of time talking about this, but I know that a lot of people in this virtual room probably know more about the CCP than I do. For those of you who don't, though, the CCP is a snapshot of 5% of the credit reports in the United States. Just in terms of what I see as the strengths and weaknesses for this analysis, the big strength, of course, is because you're using credit reports. This is really detailed in terms of the credit profile of an individual. You're able to see how much people are borrowing, how many accounts they have, their delinquencies, and then a lot of other things that we're not even using in this paper. You're also getting 5% of the country. So that's really granular and really high detail. You can see a lot of people, and that gives us a lot of power in our tests. The downsides for this sort of analysis are, one, there's not really a lot of demographic information in the CCP, which creates some challenges for controlling for observables. But we are going to do our best we can to control for things that are important in our analysis. And perhaps more importantly, is the CCP only includes people who have credit reports. So if you don't have any formal credit, you're going to be excluded from the sample. So we're not going to be including people who don't have a credit score. So we see this as essentially biasing our results downward because we're not going to be getting the absolute most credit constrained people in the credit reporting universe. For information on business activity, we're going to be using the QCEW and QWI. And for information on self-employment, we're going to be using the ACS. So now I'm going to get into our analysis of credit activity. So here we're going to be using the consumer credit panel, like I said. And our analysis is really the key of our analysis is going to be comparing borrowers who we identify as being high risk to those that are lower risk. And the way we identify them as high risk, and I'm going to talk a little bit more about what this means in a bit, is we're going to identify borrowers who are in the bottom decile of credit scores as being high risk borrowers. So we're going to be comparing them to all other borrowers.
Lee, I think Larry Santucci has a question. Larry, would you like to speak up your question? Thank you.
Hi, Lee. I was just wondering whether, I know what your results say, but I was wondering, like ex ante, whether you had, or whether you could tell us any information about the coverage overlap between data furnishers in the CCP and lenders or lenders who have products that are covered by these particular usury laws. It must be non-zero, right? There's, based on the results. But did you do anything prior to sort of running the regressions and whatnot to examine what that overlap is? And is there anything where you can tell us about that?
Yeah, that's a great question and one that has kept us up at night quite a bit. So something about the CCP is that, it's a great data set, but one thing that we don't really have is that much information about the individual lenders. So we know that includes some, like, what you would call consumer finance loans. So the exact sort of things that we want to pick up, these sort of installment loans. And we know that some of the installment lenders report to Equifax and other traditional credit bureaus, but we don't really have a good sense of how much. If I had to guess, I would say more than 25%, less than 50%. So it would be nice if we had data from an alternative credit bureau. That would be, of course, the ideal, but we just don't have that.
Thank you.
So we're going to be really the key variable. Sorry, Jose.
Sorry. So I guess what you're saying is that your results have to be interpreted with a grain of salt, no? Because they don't only capture the behavior of the borrower, they also, in a way, capture the lender population.
Yeah, I think that's a fair state. I mean, in fact, I would go as far as to say that most of the borrowing behavior is due to, our interpretation is it's mostly due to the lender activity.
Yeah, but I guess what I'm saying is that if you had a random sample of lenders, the results potentially could be different. The lenders have self-selected themselves into reporting into the credit bureaus.
I see. So basically, I think the point that you're making, correct me if I'm wrong, is if you're comparing like high cost lenders who report to Equifax versus those who don't, the ones who report to Equifax may be the ones who are more concerned about following these sorts of laws. And that could affect the results. Is that right?
Yeah. Yeah, even if you don't have a prior, at least you have that possibility, So it is the sample is quite random from the perspective of the borrower, but not necessarily from the perspective of the lender. There is potentially some selection going on there.
Yeah, that's an excellent point. I have to think more about if there's anything that we could do to sort of address that selection issue, but that makes sense to me. So we're going to be kind of the key variable here is we're going to be looking at the total debt balance for borrowers, and that's going to give us a sense of how much individual borrowers are able to borrow. And one thing that's important here, especially for those who use the CCP in this call and know it very, very well, There's a lot of different components in this total debt variable that's in the CCP. But one thing that we feel is that these laws are not really going to matter at all for mortgage debt and student loans. So we actually constructed a version of this that excludes mortgage debt and student loans. If we just use the total debt variable in the CCP, the result looks the same. But we picked out mortgage debt and student loans because we just don't think that it makes sense to include them.
Quick question, Lee.
Sure.
Do you think this also applies to credit cards?
So that's an interesting question because, we don't think that credit cards are typically lending to the sorts of borrowers where the equilibrium rate would be above 36%, but we actually do see a decline in credit for credit cards when we break it up into components. So, that is something that we're kind of trying to understand as well. What are the sorts of spillover effects we see between different markets here?
Got it.
But yeah, credit cards are also included in this total debt variable. For those who know the data intimately, what we think is really the bulk of the sorts of loans that you would be affected by the law would be, if you go into the CCP, the consumer finance variable. And if you look at just the consumer finance variable, you do see credit declining there surrounding these usury laws. So we do see it essentially where we would expect to see it. So to get a sense of what's driving any sort of change in debt that we may see, we look at two components of debt. We look at the average loan size, which is basically the total debt divided by the number of accounts. So we view this as kind of an intensive margin measure. If you have a debt account, how much are you borrowing on that debt account? And then we have the number of accounts. So the number of accounts you have open, we view this as an extensive margin measure. So this is essentially going to tell us, are people opening or closing accounts, or are people borrowing more or less on any individual account? And of course, something that's really important to ask here is if people are getting more or less credit, that doesn't tell you if it's good or bad for them. So we're also going to look at whether borrowers are 90 days or more delinquent on their debt, which can essentially give us a sense of their credit health. So now, just so that you understand these variables a bit better, I have some descriptive statistics on the risk score. So here we have the distribution of risk scores across these 10 risk score deciles for both the control and the treated states. So really the thing I want to highlight here is that if you compare the control states to the treated states, the distributions are very, very similar. So it seems here that the borrowers in these control states are pretty reasonable controls relative to those in the treated state. And then if we look at how much people tend to borrow according to risk score, you can see here that kind of intuitively, if you're in a higher risk score decile, you're able to borrow more, but only up until a certain point. And just as a preview to the results that we're going to see later, I calculated the average borrowing before and after the usury limit for each of these deciles. You look at the first risk score decile, you see that there is a decline in borrowing after these laws pass, which consistent with a credit rationing effect there. But what's interesting is that if you go up to the 6th, 7th risk score decile, you see that there is a increase in borrowing that occurs. So this indicates that there's some sort of reallocation in credit that could be occurring. Of course, you wouldn't expect that everybody is borrowing from these sorts of lenders. And when you get up to the really, really high risk scores, the 9th and 10th decile, those are just you're not seeing that increase of credit anymore. But this is, of course, a very ad hoc way to think about this. So to be a little bit more formal, we're going to run a difference in differences analysis, where we're going to compare different credit outcomes and the delinquencies for treated and control states before and after the usury limits pass. We're going to use individual and quarter fixed effects. I'm going to move through the diff and diff kind of quickly. And the reason for that is what we're really interested in is seeing heterogeneity according to the risk score. And that's going to come next. And the reason why we're more interested in that is if you just look on the aggregate, how things are changing for treated versus control states after these usury limits, nothing really happened. And the reason for that is you could see when you looked at that figure I showed you, it's kind of a wash. If you compare borrowers with very low risk scores and those with very high risk scores, if you pull them all together. So what happens if we focus especially on the borrowers in the bottom risk score decile? So here we're going to run a triple difference analysis where we're going to see how different borrowing and creditworthy borrowing as well as the delinquencies change after these usury limits for borrowers that are high risk relative to others. So here I mentioned before, we're going to do what we can to control for demographic characteristics, just considering that the CCP doesn't tell us much. So, well, one, we're going to control for age because that is in the CCP. But I think even more importantly, something that's really nice about the consumer credit panel is you can see borrowers' location. You can actually see their census block, but we're going to use their zip code. And we have 5% of people with credit reports in the country. That's a huge amount of people. I think if you look at our observations, it's around 45 million. So that's going to allow us to use zip code by quarter fixed effect in these regressions, as well as individual fixed effects. What we're controlling for here is just all time invariant individual characteristics. So just everything about a household that doesn't change over time. And then everything that's changing for the zip code that they live in over time. So we're going to be able to control for a lot of the unobservable characteristics that you would be most worried about in this sort of analysis. So first thing we're going to do is we're going to ask, how does lending to high-risk borrowers change after usury limits for those in the state with a usury limit relative to those not in the state with a usury limit? So first, obviously, you're doing any sort of if and diff or triple difference. You want to make sure that the parallel trends assumption holds, which here what that means is if there was no usury limit, things would have changed similarly for borrowers who are high risk in these usury limit states relative to others. If we look to the left of t equals 0, which is when the usury limit gets passed, what you're going to see is that there doesn't really seem to be a differential trend in risk scores in a borrowing for these borrowers relative to others. But then after the usury limit gets passed, there's a really big drop. It's about 16% of the sample mean, 14% of the sample standard deviation. And it's persistent. So you see this rationing of credit toward high-risk borrowers. And again, this is not something that's necessarily surprising, but we're seeing it in our result. So now the question that we're going to ask is, why are we seeing this decline in borrowing? Are fewer people actually taking out loans? Or when people take out loans, are they taking out less money? So here, this is actually pretty interesting. And the reason is we don't see people taking out less money. In fact, we see them conditional on taking out debt. They're taking out more money. And the reason for that is that if you go and talk to these high-cost lenders, what they will tell you is after usury limits are passed, because they're not able to charge the interest rates that they like, they have to lend out more money to make the math work out. They will essentially capitalize costs of lending into the debt. When you look at the extent, Raluca, did you have a question?
Sorry. No, I was just thinking, yeah, that's kind of at first value could be a little bit counterintuitive, like spending increases despite you have reduced credit. So I was thinking one explanation could also be that consumers may be substituting to informal lending channels, like maybe pawn shops, payday lending, borrowing from friends and family. I don't know if that's applicable, or if you can rule that out, but yeah, just a thought.
Yeah, so that definitely could be. I think I would say probably not for payday lending, because my guess is in this setting, there's going to be, if you have these sorts of usury laws passing, there's probably bans on payday lending passing as well. But pawn shops, I definitely think that could be the case, because since pawn shops, there's collateral, they can often lend at a rate that's lower. In fact, something that we have seen, but we're not using in the paper, is we've seen this survey evidence from like an industry group that works with non-traditional lenders. And when they survey people and ask what they're likely to do in the absence of these loans, one of the big things that comes up is borrowing from friends and family.
I see. Thank you. And one second potential explanation could also be an increase in wealth effect, because these borrowers avoid now the high cost interest payments, so they accumulate maybe more disposable income. So I don't know if you could somehow disentangle between spending funded by savings rather than actual new borrowing. But yeah, some thoughts on this as well. Thank you.
Yeah, that's a good point. So it's tricky to say because like we don't have great spending data. We have tried doing some spending analysis, but the results we get are not consistent. Like sometimes we see spending go up, sometimes we see it go down. It's not easy for us to trust. The one thing that does point away from that is that if we look at delinquencies, like the main channel that we would see is people are just able to service their debt better. And if that was the case, we would expect to see delinquencies drop, but we don't really see a change in delinquencies. So it could be that people are spending less money on servicing their interest, and in that way they're able to spend more, but we haven't really seen anything pointing in that direction yet.
Thank you.
So the one thing I do just want to make sure to talk about before moving forward is we do see a really big drop in accounts. So this means either borrowers are closing their accounts, or people who had wanted to previously open accounts no longer are opening those accounts. And that's about a 20% of the standard deviation, 20% of the sample mean drop. So this decrease in lending is mostly due to a reduction in borrowing on the extensive margin, not the intensive. And as I was just mentioning, we don't see any change in delinquencies. So this kind of calls into question whether borrowers are benefiting from the law change in terms of improvements in credit at the very least, although we aren't able to say much about their spending overall. We also have the results in terms of tables. That's something very similar to what's in the figure, just to make sure that I could go through the small business results. I'm not going to spend much time here. But one thing that we asked here, and this is very related to the question that Jose asked earlier. I think there's a really...
Before you get into that, maybe the reason why you don't see a change in delinquency is because it's probably very difficult for this population, for the lender to kind of, rank order. So that might be one reason. That, the lender is just find it very hard to rank order these borrowers. So even if there is a constraint on the interest rate, lending to certain borrowers decrease, still the population that you have, is very similar because they are very difficult to rank order.
Mm-hmm. Yeah. Yeah,
anyway,
that makes...
I don't expect an answer. This is just kind of an intuition. I think it's kind of an interesting result. So.
Yeah, no, I mean, I think that's fair. I think once you get low enough in the credit scores, it's difficult to distinguish borrowers.
We have some questions also from others. Don't know, whoever wants to ask a question first, please go ahead.
Hi, and I'm sorry if I missed this, but how do you define high risk score? Is it measured like current risk score, or is it measured sometime before the reform before the law is implemented, because risk score will be obviously affected by all these outcomes, right? It's just some kind of function of all this. And if you do it before, like some kind of period fixing, what you may have is that there is some mean reversion in the risk score. So like really bad borrowers, if you just pick them a point in time, they may tend to get better just because like that's probably where something really terrible happened to them, while others may behave differently, right? So I just wanted to understand this design and how you separate those people. Thank you.
Two great points. So on the first point, we are defining based on the risk score before the law passed. We're taking their average risk score over the year before, so the 4 quarters before the law passed. And again, just to reiterate, these are the bottom decile risk scores. That's what we think of as being the high risk group. On the second point with the mean reversion, totally agree. We had actually for a while been using the risk score as an outcome variable in this, and we took it out for that reason, because essentially like that was just regressing like the left-hand side variable on the right-hand side.
Malik?
I want to...
Oh, go ahead.
Just one thing, I saw my co-author raise her hand, so I want to let her jump in case she has anything to say.
Yeah, I was just going to say, Slava, excellent point. I think, would you be happy, as Lee said, what we did is we essentially used an average over the last 4 quarters, right before the usury change happened. Would you be, will your concern be relatively allayed if we took multiple pre-years? Let's say we took all the pre-years, we looked at average scores over the period, looked at the decile. So it would include, if mean reversion is your concern, then over that time period, there'll be ups and downs. So kind of they would be canceled out. So we could do the decile based on the entire pre-period rather than just a year. Would that make you happier?
Maybe we can talk
solution.
offline, but we had a paper with a similar problem, and we decided not to even split based on that, like just on the risk score, because it just introduced all this weird dynamics into the results, right? Because you have this bottom deciles or whatever, really high risk group, but then their pass is not the same as a different group, right? Because they were so low, then like you may expect them to go up, and no matter how you define it, they will be like you kind of selecting them into like the recovery path, so to speak, right? So they will be getting better in the future. And then if you're just comparing them to some other people, then like they may not be on that path because they didn't have this bad drop in the score, right? And I think this, if I understand the specification, it will be kind of part of the difference. So like you will be, among other comparing people who are like really like had very, very low score, and then now they will be recovering fast, to people who are not that like that, right? Really, really low score and not recovering fast. So that, I mean, I don't know how much it will change. Maybe as a robustness check, you can do something different, like just have separately high risk and like not so high risk, and then show those results. Maybe that can help. I don't want to take too much time. Sorry. We can talk offline.
Prime.
Yeah. So just like do them separately. Maybe that will help, because I think if you just do the interaction, it will kind of maybe introduce something in your specification, which is not, it's somewhat artificial, or like, you know.
Makes sense. Malik, you had a question?
Yeah. I'm just trying to think about, or I guess, how are you thinking about these estimates? So like, I mean, I think Jose raised a point about there may be some questions about who ends up reporting, and so there may be certain groups that see changes in their loan portfolio that just aren't reporting to the credit bureaus as a result of that. And I'm thinking on the other side of the house, to what extent are you thinking these usury laws are actually having an effect? So like one easy example is in the credit card case, the interest rates are governed by the state of headquarters. So these usury laws don't apply. And then something similar happens with tribal lending, which actually since 2012 has really made big inroads in the online space. And so I might be in a state with a usury law, but I can find a tribal lender that'll charge me, 600% APR regardless of my state's law. And I don't know if they report.
So for these specific laws, our sense is that they apply based on the borrower's location. And of course, it is always going to be possible that they could find an alternative source of credit that is not covered by these laws. So, it's hard to say. I think this could just be my own sense of cautiousness. But when I do these sort of like reduced form analyses, like I am always more focused on the qualitative interpretation. So I feel very confident that we see borrowing dropping meaningfully for these high-risk borrowers. I'm not going to hang my hat on this specific number because I do think the sort of concerns that you're bringing up and the ones that Jose was talking about are totally valid and fair.
Well, I guess my concern is, just making sure to caveat or pin it on the certain lenders, right? Like, yes, in this sample, loans are dropping, but it could be that it's dropping just because people are diverting to, like we've already said, all of these range of other family and friends or informal channels or things like that. And so, depending on if loans are dropping overall, then like, okay, that might be a policy win. But if loans are dropping just because people are moving to like black market lending, then that might not be a policy win, right?
Yeah. And I wouldn't say necessarily that loans dropping indicates a policy win. It's just that the policy is kind of doing what it was supposed to do in terms of the volume of credit. But I absolutely agree that people could be moving to black market credit. That's something we're just not going to be picking up. I would say more so that we're picking up the formal credit market. So if people are moving into the informal credit market at all, then that's something that's totally outside the scope of this analysis.
So Daniel has a question, and then you have about 10 minutes left after that.
So I'm just a little worried also about who the lenders are. And I wonder if you can separate some of those lenders, because some lenders don't do any lending in the bottom decile in the first place. And so, getting a sense of who they are and which ones might be more impacted than others. But I will point you to something that Pew did certainly a long time ago when Colorado produced a usury cap at, I think it was 99% or something, not unlike New Mexico. And what they showed was, in part, they got rid of a lot of brick and mortar places. So the number of brick and mortar small dollar lenders, payday lenders, dropped by almost 50%. Now, the lending activity fell by about 10% at most. And so they were able to certainly show in that example where the amount of credit that was available didn't decline dramatically at all, but rather the lenders that had to charge high prices because their costs were so high, the economies of scale grew because the ones that stayed in business managed to do double the amount of lending, and therefore their overhead per loan pretty much dropped in half. So that's just a way to be thinking about this.
Yeah, I think that's a fair point that some lenders are not lending to these types of borrowers. We haven't used any data at this point that can allow us to identify the lender. So, that's something that maybe we could explore later on. But at this point, this analysis is just can't do that. As far as the second,
Let me add one final point, and that is that in some cases, what the legal limit is really up in the air. So in some cases, there are fees, application fees, and the like that don't get counted into APR. And that can be problematic as well. We've actually talked to some of the banks, though, that actually do these kind of small dollar loans. And in fact, when it comes to military personnel, they just don't charge them any interest at all because they don't even want to worry if they happen to potentially go over the limit. They just there's just no interest for them. So we've reached out to a lot of players. So there's a lot of nuance in this process. So I just want to point that out in terms of who's even near the limits for hitting whatever the new usury cap would be.
On the second question, I don't think that's necessarily inconsistent with what we find, because we do actually see that lenders lend more money to people who have marginally better credit after these laws pass. So lenders aren't necessarily pulling back credit; they're just lending to different people. So I think that is actually it's not exactly what you were saying before, but it is similar, that the amount of credit isn't contracting, just where it's going is different than before.
Yep.
On the point of the complexity of these laws, point taken, these usury laws are super confusing and complicated, and there's a lot of great work out there that really tries to parse out the details. To be honest, we don't do that so much, but our approach is to do some robustness checks to kind of make sure to focus on the cases where it's as simple as possible. So we have one check where we use a control group of just Wisconsin and Utah because it's very well documented that there's absolutely no usury cap there. For another, I'm glad you brought up the military example because we tried a version of this where we only looked at Illinois. So Illinois, their law was based on the military APR. So when we look and it's only based on the military APR and there's not quite as much complexity as these other cases, we do see that things look pretty similar.
And I would say keep an eye on Virginia. I live in Maryland rather than Virginia, but their legislature passed a law that pretty much is an inclusive usury cap at, I think it's 14% or 12%,
oh, wow.
or 10%. So this is coming up pretty soon, and if that gets signed by their governor, it'd be interesting because there seems to be very little wiggle room around this cap when it comes into place. So that's going to be a great test case for you in another year or so if it gets signed.
Yeah, that's good to know. We'll keep an eye out.
So you have about 8 minutes left. Hopefully that's enough.
Oh yeah, definitely can make that work. So the big piece of the contribution here is related to business conditions. So we know from existing work, from looking at historic examples, that usury limits can slow business activity, especially among smaller firms. So we're going to see in this example, we see that there's this decline in lending to high-risk borrowers after usury limits. If these borrowers are in any way using these loans to put into their businesses, then this could affect business activity. So we're going to see if business activity slows after usury limits. And in particular, we're going to focus on the sort of businesses that you think would be especially likely to use these types of loans. So these are really going to be tiny businesses that don't have access to a ton of capital. So first, we're going to be looking at small business intensity, which is going to be the percentage of business establishments in a county that have 500 employees or less. 500 is a lot. We also do a version with 20 and 50. And then self-employment intensity. So this is the percentage of the population that's self-employed. And I know thanks to the work, thanks in part to the work from one of the RAs I shouted out before, that self-employment is actually defined primarily as being the sort of people like gig economy workers in this sample. So here, this is going to be the sort of example like you're an Uber driver and you need to fix your car. So you take out a loan. So that is going to be the sort of variation we're capturing when looking at self-employment intensity. So I'm going to move past the summary statistics just to get through this quickly. But we look at just the diff and diff, seeing how things change before and after the law without looking at any sort of variation in terms of small businesses. We do actually see that there's a decline in establishments as well as employment and wages. And generally speaking, there doesn't appear to be much of a pre-trend here. So the parallel trend assumption appears reasonable in this context. And we see that after these laws passed, there's a decline in establishments of about 19 establishments for treated states with usury limits relative to others in control states. But now when we get to the heterogeneity, the really interesting part, we see that there is a pretty substantial decline in establishments for counties that have a lot of small businesses that are in a state where a usury limit was passed relative to others. And this is especially corresponding with a decline in wages. So we see that establishments are shutting down in these counties and fewer wages are being paid out. So here you could see that there's a decline of about 9 establishments in these small business intensive counties. And the way to think about this is 9 businesses incremental on that 18 you saw in the different. So this effect is stronger in these small business intensive counties. So this indicates this matters more for places where there's a lot of small businesses. If we look at self-employment, it looks pretty similar. We see that there's a decline in establishments for counties with a lot of self-employment where a usury limit gets passed relative to others. And this also is related to wages. So these two pieces of evidence are consistent with a big way that you see business activity changing after these usury limits is that people might be borrowing these consumer loans and then indirectly putting them into their businesses, which could lead to a shutdown in establishments. So I just want to make sure that you understand all the things that we did to make sure that the results are robust. So something that you may worry about, and this is very similar to the question that Slava was asking before, although not exactly the same. It is, of course, difficult to understand what's going on in a triple difference sometimes. So what we do is we do just a diff and dip analysis within the treated states to see how things are changing for high-risk borrowers to others within the treated states, and looks pretty similar. We actually did something, although it's not in the paper, similar to what Slava was mentioning, where we look within high-risk borrowers comparing treated to control states. That also looks pretty similar. Something that you may be concerned about is Ohio's law is actually pretty complicated. In the way that we were discussing earlier, there's a lot of ins and outs where in some ways it's actually not so bad for the lenders. In other ways, it's pretty bad for the lenders. We do a version of the test dropping Ohio. Things look pretty similar. Obviously, COVID is a problem. So we do a version of the test where we drop the COVID years. Things look the same. Like I said before, we keep only Wisconsin and Utah in as controls. Things look similar. And we try to get a version where we don't just use the SBA definition of small businesses. We use a version that feels more intuitive to us. So we have a version using 50 employees or less. This is actually, in the paper, I realized afterward, we put in the version with 20 employees or yet less. Both of them look pretty similar to what we have here. So just to conclude, these results show that lending to high-risk borrowers decreases after usury limits. Again, this is not anything that is super different than what you've seen before. It is interesting to see that there's no improved credit standing that goes with this decrease in lending, and that lenders are moving credit to these marginally lower risk borrowers, so not necessarily leaving the state. What is really interesting is that this reduction in credit to high-risk borrowers seems to be associated with some sort of real effects. So, I mean, this we can't observe for sure, but it's consistent with individuals being able to borrowing these loans to invest in their own self-employment or small business activity. And then when these loans go away, they're not able to invest in the same way as before. So this leads to a decline in business establishments. So in our future work, we're really trying to understand this real effect better. How do these usury limits affect business activity? So thank you all for your questions and for coming. This was super useful and informative and fun.